Welcome back to Barry Charles, your one-stop shop for everything finance. And yes, we're going to talk about the greatest cruise line of all time. You right? You right, Barry? Are you saying the right thing here? Isn't RCL better? Yeah, well, I'll get to that one next week. But let's talk about CCL right here, right now. What's happening with Carnival Cruise Lines? It was down in the dumps. Nobody wanted to share. This is a stock that I used to own. Now I no longer own. And this is, but it's still a stock I'm interested in looking at. And clearly I missed the boat in terms of taking the great, what it went down to. But in saying that, I brought into another stock, they're 3-4x from there, so I done better off with making the decision to change stocks on this one and adding to another stock that I believe was going to have potential long-term return. So this is CCL stock. We're going to talk about this right here, right now. We're going to talk about it. And yes, and that stock, if you want to know, was Meta. Yep, absolutely. Boom, boom, boom. I just mean bang, bang, bang. Meta was going down, down, down. And now, boom, we're selling towards profitability. And on the lower end, made over 300%, and overall made close to 100% right now. So that is what you're talking about stock picking. Yes, boom, up you go, rattle up you go. I mean, obviously, long-term potential still with Facebook to grow is still an opportunity. But back to CCL, yes. This is what you're here for, revenue, yes. We're going to talk about revenue, net profit, earnings per share, PE ratio, 52-week range. This is a stock analysis for CCL. How is this company going? Is it going to continue to improve, or is it going downhill? Is it going to be a short uphill, then downturn trend? Let's talk about it right here, right now. Welcome, guys and gals, back to the channel. CCL, what is happening with this company? Remember to stay tuned to the end of the video, and I will tell you potential intrinsic value of the company right now and where's a possible buy point. Not financial advice, but let's get to it. Yes, well, CCL, well, this is for anyone that doesn't know, it's a cruise ship company that sails the 7 seas. It's the biggest cruise company in the world. Simple as that. It has the most ships, it has everything in between, but doesn't necessarily mean it is the best of the stocks. You have to make that decision for yourself. Just to give you an example, if you talk between Carnival Cruise Lines and Royal Caribbean is more of a premium stock according to investors and is always trading at a higher premium than CCL. For whatever reason it is, that's just the way the market has trended for a long time. Let's have a look at the revenue. Well, the revenue is starting to boom up again. 12 billion last year to 21 billion 2023, and 2022 was 12 billion. So absolutely boom, yes, lightning for this sort of company to have that sort of revenue growth. But when it was the negatives before that, well, that or close to negative before that, you can see why it's really skyrocketed and why the stock price has gone up a bit too. Yes, net profit, if we're looking at the net profit, it's been a bit of a all over the show, from 9.5 billion to 6 billion, and now getting close to profitability, minus 74 million. So they were expecting profitability this year to get bounced back after a lean time. If you've owned the stock for a while, you really haven't gone anywhere. But in the last 52-week range, we'll look at that now at $8.37 the low, and then 19.74. So if you bought at the low, you pretty much doubled where the stock price is now at around $16. So congratulations if you have. But obviously, if you were at the $52, thank goodness in my deep heart of hearts, I was not in the stock at that time. Thank goodness for that. I did buy the stock earlier than that, way earlier than that, and then sold out before it even rose up to $50. So I took my profits there, and I actually went to buy in again. And let's just be fair dinkum. Yep, I decided to take a little bit of a loss, and I said, well, I'm not going to let this money sit here for a couple of years and not have anything invested into it. So I took the little bit of loss. It wasn't a major loss because I got it about $10 and went down to 9.8. So I just shifted the boat and said, nah, this is all going into Meta. The Meta stock's flying down. we got to buy into it, and it's proven to be the better investment. So that's just showing you what sometimes you need to know when to get out of a stock. CCL, simply putting it to you, so as I continue to talk about it, CCL is the stock that is not going to be a world beater, but if they return to dividends, which at the moment there's no dividends, but there's talk there could be a dividend coming. We will see if that actually eventuates or not. But if a dividend returns, then the stock will go up a bit, because eventually, when it was up at the higher ranges, it had dividends and everything. If the dividend returns, the stock will start to see creep up even more. Short interest at the moment is 8%, so it's still pretty high. So people think the stock could go to zero. We'll have a look at a few of these metrics to see if you can believe in this. The stock overall is a $21.6 billion company at the moment, $21.6 billion market cap. When you compare it to a company like Royal Caribbean, it's at $32 billion, and you think to yourself, doesn't CCL have more ships? How come they're not being worth as much? Well, it's telling you sometimes it can be just how quality of business are, and maybe RCL is the better quality business out of CCL. Not financial advice, you've got to check this all out yourself. If we look at the total assets of this company, CCL, you're looking at a bit of a loss on that, from 51 billion to 49 billion, as well as, but the liabilities went down a couple of billion from 44 to 42. So that's, but in terms of total assets to total liability ratio, it's not great at all. For my opinion, I like to see it halved. If you can possibly get that, and it's a better situation for me to be in. If we look at in terms of the free cash flow, you're looking at about $1 billion at the moment, $1 billion, which is not good when you have something ridiculous like $284 billion. Yes, I'm not kidding, folks. I mean, not 200. Yeah, so much money, and 2.8 billion. Yeah, sorry, 2.8 billion in long-term debt. It's not a good sign if you're into this company. There's a lot of debt involved with this company. Yeah, 284 billion. It's just off the charts. Yes, off the charts. That's where the question mark you have with this company is the long-term debt's out of the, and they really got a long way to go with the free cash flow. So where they're going to pay this, so they've got a long way to go, very long way to go in terms of so that's a big danger point there. Shares outstanding 1.3 billion. Yes, and then it has doubled since so that's doubled since 2018. So yes, they are diluting you absolutely to the hill, folks. Absolutely diluting you. Not a good place to be. As well, with the major high debt, question marks all over the show there, how you work on improving the debt there, because it's really high. Yeah, at 20, yeah, sorry, if I say 284, it's 28 billion. Sorry if I got you a bit over the top there. It wasn't that ridiculous, but yeah, 28 billion. I mean, that's most of the liabilities, like quite a bit of it. So yeah, so that's a big thing. 28 billion, you're only getting 1 billion in. It doesn't make sense. It's going to take you 28 years to pay it off. Well, they're going to have to start really boosting that up to get going. So that's something you have to look out for as an investor in CCL. So what can CCL do? Well, there was talk about selling some ships to get some revenue going. There's potential, but you've got a limited market who are going to buy those sort of ships. So yeah, it makes it hard, and often you might take a loss on it as well, but it can be good to offset some growth. Can they get more people coming in? How do you get that? Do you start new destinations? Do you add more ships and add more debt? Like, this is the question marks that CCL has at the moment. Because yes, if they run out of money eventually with this so much debt, they could go to zero. That's why there's a short market on this one. There's a potential they could go to zero if they cannot continue this around and get profitability, because they just won't make money and will fall over. I don't see it happening for this company, but that's a big concern though, that they're going to take 28 years to pay off their debt. It's just not good at all. Something you'll have to look at if you're looking to invest into this company. Is it worth the risk? Return on invested capital is 12%, which is okay. which is actually better than Royal Caribbean. So there you go, folks. There's a positive there if you don't have CCLs there. So CCL's a potential play on this. But yeah, so those are a few things that CCL has to do to really get themselves right up the table in terms of being a good company to invest into. Well, this is what you're all here for, the intrinsic value. What is the intrinsic value roughly of this company right now? I use TradeBrains for this, Graham's calculator. You can check up TradeBrains Graham's calculator and it'll come up for you. You can use the software for free. No affiliation, just something I use just to get a basic tool to understand where the company is intrinsic value towards certain in terms of earnings per share and growth rate, and then you can go from there to figure out what you think. So with this, I've decided, yeah, let's go, folks. The stock price is around $16.40. That's what I'm going with. The earnings per share is $1 at the moment, with a 5% growth rate. So with a 5% growth rate, there's a bond yield that is automatically on there, so you don't have to worry about that. Gives you an intrinsic value of $19.30. If we add that up to 10% growth rate with an earnings per share of $1 in the same current share price, then you're looking at a $29 stock. So at the moment, if you think that's the future, it can double up from here. If you think it can double its earnings per share, then you're starting to look at a $54 stock. And then if you think it can continue to grow and it's going to go to the moon and go to 3, earnings per share, so triple the earnings per share somehow, and with a growth rate of 15%, then you're looking at $120 stock. So what does this mean? Do you load the boat, the stock's going to 120? Absolutely not. I'm not saying it can't go to 120, but it's going to have to do quite a few things. First, they've got to turn around and start giving some shares back. That's one thing. So share buybacks, they haven't done them for a very, very, very long time. Something they're going to have to do if they want to really get motivated in terms of giving you some value back to the company. That's one thing they need to do. They've got to pay down this long-term debt. Absolutely something horrendous. They've got to start paying that down. That's the first thing they'll do. I'll do that before coming back to a dividend. I don't care if you wait another year or two before you get a dividend. You've got to start really getting their long-term debt down. Once you get their long-term debt down, then they can go back to the dividend. I think that's what they should do. And also, as a company, they need to grow. If you're not going to grow, you're going to stay stagnant. And even though the price has dropped, well, we gained 100% in the last year, is it really worth value? Well, yeah, currently I'd say it's about fair value. Where would I want to buy the stock? I think the stock where you want to buy it was already has been in past. Whether it goes back there, you never know. But yeah, to me, I think at their lower $10 range is where you want to buy the stock if I was going to invest in it now. Is there a potential it can go back up to the moon to $50, $100? Everything's possible. But obviously, yeah, dividend's going to be a big one for this company. Dividend for most of the shareholders that were in this company before and sold out, to come back in, they'll want to see a dividend return. And I have to continue to improve with the revenue and the net profit. Obviously, getting back to profitability will help. But yes, to me, if I'm going to say what I think the intrinsic value is right here, right now, today, if I had to label the intrinsic value of this company, I'd say when you add that lower debt into it, I'd probably say $14 would be my fair value at the moment. $14 is about 16.4 if you're looking at fair value. So if you're wanting lower, you're going to have to get under $10 for me to make it worth an investment. If you invest now, you could be stuck in this investment for another 2 years before you see anything. But that's the thing with the long-term gain. I would expect the stock to easily go to $30. But you could be waiting 5 years for it to go, or it could happen 6 months. You never know. But yeah, until the dividend comes back, you won't see something ridiculous out of the stock, unless they somehow pay this long-term debt off somehow. But yeah, CCL is definitely a stock to follow. I wouldn't say it's going to be a life-changing stock for you. If you expect that, you're in the wrong stock. But if you're wanting a solid stock that should give you good gains over the next 10, 20 years, it's potential, but then you've got to realise that you could lose it all with a company that's got so much debt. So that's the risk you got to take, not financial advice. That's just a little bit on CCL, stock analysis, and where the intrinsic value is at the moment. This is only what is happening currently. If stuff changes in the business, you've got to reevaluate everything. But I will be here every week, 3 videos a week, and I'm going to be doing the same sort of videos, stock analysis and intrinsic value on companies you love. Come back, remember to like and subscribe, and share it with all your friends, and I will be back with another video shortly.